and that's going to come from corporate America, and they're not spending aggressively yet, and that may not come for a little while. So I think they are sort of sitting on the sidelines a bit around the US. They're certainly not as negative as the markets. And as for China, well, they're slowing to a more sustainable pace, they note, but that's still 8 to 9% growth at least, if not higher. And of course, you only have to look at our national accounts that we got last week, where we had nominal economic growth in this country of 15% annualised in those 3 months. Now, you're not seeing that because of our relationship with America. You're seeing that because of our relationship with China and India. China and India are producing 10 to 15% nominal rates of growth, and that's what we're tapped into here. And that's going to really hit this economy when that investment boom kicks off over the back half of this year.
Can I ask you about the labour market as well? The quote in the statement is the demand for labour has firmed over the past year in line with improving growth. Growth in wages has picked up somewhat, as had been expected. And I ask this obviously because you guys put out the ANZ Job Ad series, and you're talking about the jobless rate being below 5% before the end of the year. How much or how soon could that feed into a wages inflation problem for the RBA?
Well, we saw in the last commodity boom that the RBA got themselves into the position where they waited for inflation and they waited for wages. It's too late then. They can't wait. These are lagging indicators, and once you wait to have a problem, you're not going to get rid of it early. They know that. We don't think you'll necessarily see any wage issues really arise until next year. We're starting to get some anecdotes of it. We're starting to get some of the surveys picking it up, but it's pretty well behaved now. The fact that they're noting it, that's what's important. This shows you that there has been a slight shift in their thinking, and I think the right view is that rates are going to go up here and probably before Christmas.
Can I ask you, Clifford, as well, just to respond to some of those comments from Warren there?
Hi, Warren. Yeah, look, I totally agree with you that the economy is going to be strong. We've for some time known that we're moving into China and India. Exports from Australia to the US are only 5%. Two-thirds of our exports go to Asia. Everyone's aware of that and factoring that in. And certainly there is going to be some wage pressure, particularly in the export area. That doesn't mean that's throughout the whole economy. And also, I think it doesn't mean that we have to raise rates just because we have strong growth. I mean, this old world thinking of growth equals inflation, we really have to throw that out the door. You can have strong growth now with low inflation. The Reserve Bank is about targeting inflation, not growth. And I really think we need to push the Reserve Bank to re-emphasising that its focus is inflation. And in that paragraph you mentioned, Brooke, towards the end there, it talks about tobacco tax perhaps lifting the CPI data to above 3% for the next few quarters. So clearly the Reserve Bank isn't going to overreact to a number above 3% in the quarterly CPI for a few quarters. So I think, you know, that October number's not that much of a threat. And we really are looking into, you know, late of the first half or middle of next year before, you know, any sustained unexpected high inflation would create a rate hike.
Warren, what do you think of the idea of growth not equaling inflation necessarily? Throw that out the window.
Yeah, no, I wouldn't be throwing that one out the window just yet. I'm not sure what old school thinking means on that case, but what I'm identifying here is the fact that this economy can't go through two booms. We can't have a mining and investment boom, and not just mining investment, but infrastructure investment boom, and a domestic consumption and housing boom. We have to contain the domestic economy to free the resources up for this investment boom. If we don't, it will create inflation. Yes, right now we're not getting that wage pressure in, say, for example, the retail sector. But next year, if consumption's running in real terms at 4 to 5, or retail sales are running at 8 to 10, there will be jobs being put on in that sector, and they'll be competing with the miners for that scarce labour, and you will get wage pressures across the economy. Now, I'm not saying that we need to keep retail really weak, we just can't let it boom. And we saw consumption growth annualising out at, you know, around 5% in Q2. Granted, it was cars, but next quarter it may not be cars, it may be in department stores, and then you'll start to see those anecdotes, the negative anecdotes, fall away. The bottom line here is that households have got income growth of 6 to 7%, and unless they save that, they're going to spend it. And I don't think this economy can handle both a consumption boom and an investment boom at the same time without creating that inflation.
And Warren, just before we leave you, in talking about in the context of a boom situation, let's bring in the political situation. We believe that we'll know who's running the country within about 15 minutes' time. Either way, we've still got a minority government, though. How does that play into the bigger picture in terms of the policies that might come out from that minority government? And is there any implications that you can see for the RBA in the next couple of years?
Well, I think in the short term it just means not a lot gets done, and in strong economic conditions that's not going to have too much of an effect. You need effective government in times of crisis. You don't necessarily need it when things are going well, which they are. The problem for Australia is long term. That is, we have got a once in 70-year opportunity here to bank the economic well-being that this commodity boom represents, but that requires some long-term policy reform and long-term policy thinking from our government, and you're unlikely to get that when there's a minority government.
Warren Hogan, we really appreciate your time today. Thank you.
Thank you.
Warren Hogan there from ANZ as we watch that Australian dollar just dip after the RBA's statement. Let's find out what the share market did. Cam Peacock has been patiently waiting there in Melbourne. Thanks, Cam, from RG Markets. Interesting because we've got these two issues. We've got the RBA statement, but we've also been watching the political rumblings out of Canberra. Just tell us where the market's been moving on all of that.
Yeah, look, the market's been was pretty flat up until about about 2 o'clock, or just before we heard Katter announce his intention to vote with the coalition government. And on that news, we did see the equity market, the ASX 200, spike up by about 13 points. We saw the Aussie dollar spike up about 20 odd pips. But then when the realisation sort of filtered through the market that probably meant that the other two were going to side with Labor, we saw that immediately reversed. So very little change in the washout of all of that. And then of course at 2:30 when the rates decision hit, not much of a surprise there. In fact, it was probably the biggest non-event you could possibly speak of. No change at all on the market. I mean, when I last I jotted down, we were down 1 point just before the rates decision hit, and as of about a minute ago, we were effectively unchanged. Looking across some of the major banks, all of them unchanged from the announcement. BHP was flat as well from the announcement. So was Rio Tinto. Did see a little bit of a pickup in some of the discretionary retailers. You had the likes of Myer down about 0.3%, Harvey Norman down about 0.6%, and they paired some of their losses once the news broke. But all in all, a fairly flat reaction from the market.
Cam Peacock, thank you so much. Appreciate that. Cam Peacock from RG Markets in Melbourne. And coming up on Rates Reaction, we'll talk about whether the Aussie banks might lift interest rates. No matter what we're talking about here on Rates Reaction today, will they go independently? And how will it impact your mortgage? We're back in just a moment. Welcome back to Rates Reaction. Clifford Bennett is with me, Chief Economist with Hurston Economics in studio, and joining us to give his take on the decision too and the ongoing developments on the political front, which is happening as well at the moment. NAB's economist Dave De Garis joining us from the Sydney camera. Dave, just give us your first impressions of the statement and whether there's any clues there about whether we might get some rate hikes through the course of this year.
Yes, Brooke, I think they've opened up their options a little bit more now. So, they said they're keeping rates, rates are appropriate last time. Now they're saying appropriate for the time being. So there is a sort of a temporariness to this this statement. I think they've just tweaked it to suggest to people also that, if you're reading between the lines, if there was to be any change, then it's more likely to be up than down. So I don't think they'd be unhappy with the way the market pricing has changed over the past couple of weeks. Just a little bit of detail of the statement, Brooke. There's no reference in this particular media statement today to consumer caution as there was last time, so we'll be interested to see what they have about that in the full minutes. They're a little bit more upbeat on the business investment outlook. They're saying last time they expected to increase, now they're saying it could increase strongly, and emerging signs of more willingness to lend to business as well. So some little nuance changes there that suggest that they're sort of less worried about the outlook for the Australian economy going forward. Maybe the risks are just tilting a bit to the upside. I mean, the fact they've left rates at 4.5% means that they're reasonably comfortable where they are. But you'd have to think if there was to be any change in the near term, 3 to 6 months out, then it's more likely to be up than down, Brooke.
Dave De Garis, thank you so much. I think we have to leave it there. We appreciate it, though. Thanks, Dave.
Thanks,
Clifford Bennett from Hurston Economics, a very quick one from you, that the omission of the consumer caution. I know that the NAB was looking for that ahead of the statement today.
The retail sales have been firm, so that's been encouraging for the RBA on that front. But I mean, one of the things we've left out of this is the RBA probably hiked too quickly too soon, and that's why we're going to have this extended hold, I think, at 4.5%.
All right, and of course the big thing is about what the banks do with all of this. Let's go over to Lisa Montgomery, because Australian interest interest rates have risen perhaps beyond the borrower pain barrier, some would say, Lisa. What extent do you think that rate hikes towards the end of the year might curb consumer demand, but also does it matter what we're talking about today with the RBA? Are the banks just going to go it alone anyway?
Look, I don't think consumer demand will be curbed. That's my opinion. As we move into the next phase, I think really what's been concerning borrowers is what's going to happen with this election. And for one reason or another, and sometimes it's hard to fathom, elections always put borrowers on edge. But I think that what we need to be prepared for is that, yes, rates may go up toward the end of the year, whether it's as part of an RBA move to control inflation, or whether it is the big four banks moving outside of the RBA cycle. We certainly hope that the RBA, that the big banks don't go outside cycle, and I'm sure Australian borrowers would hope that that would be the case as well. However, they're not silent when it comes to talking about the possibility of going outside of the RBA, and so we need to be prepared for that.
And, you know, you mentioned the political aspect to the housing market and to the mortgage rates as well. I guess housing affordability and the whole issue of housing was completely an omission from all of the discussion in the lead up to the election and as part of the campaign. Do you expect that we're going to see any more on that front once we've got someone in power?
Look, what was really concerning leading up to the election, we didn't have any strong policy on affordability. We didn't have any on in terms of dealing with the undersupply of property, and I think that was definitely a force that divided borrowers. They didn't really understand which party to vote for when, you know, property and property prices and the Great Australian Dream is so much a part of Australian psyche, and so it was a real issue to borrowers in terms of which way they were going to go. And I think that we now wait to find out what the result's going to be, and if indeed there'll be any strong policy. I certainly hope for Australians that there is.
Okay, and Lisa, you've mentioned the possibility of rates being raised by the banks independent of the RBA. Do you give that a strong chance?
I think there is a strong chance. A couple of the banks have been quite vocal over the last few weeks, talking about the possibility of passing on increased funding costs onto borrowers, as those increased funding costs impact on profit margins. That's what they're citing, and so there is a strong possibility that the big four will go outside of the RBA cycle. What they go and by how much will be interesting to see, and indeed if they move in sync with each other.
I know who to come to when or if they do it, Lisa. We'll chat with you soon. Thank you. Lisa Montgomery from Resi, and just finishing off with Clifford Bennett from Hurston. Literally in 10 seconds, if you can, the housing market, what's the RBA's thinking and whether we can handle more rate rises?
Okay, I think they've recognised that they raised rates too quickly, too soon. It did kill off housing construction a little bit, and they need to stand back and let it take sort of. They need a lot more water under the bridge. It's going to take time before the housing industry could stand another rate hike. The RBA will stay on hold.
Fantastic. Clifford Bennett, thank you for your time today. Clifford from Hurston Economics. And that pretty much wraps up rates reaction. The RBA's decision, I guess in some ways, has been overshadowed by the political action in Canberra today too. We've got the independent MP, Bob Katter, this afternoon confirming he will back the coalition to form a minority government. It means Julia Gillard needs the support of Tony Windsor and Rob Oakeshott to retain power. We're expecting to hear from these independents literally within minutes. We're going to join our colleagues from Sky News in Canberra to take it up to that media conference and also to provide some analysis right throughout the afternoon. So we'll be back with what it all means for the market at about 4 p.m. Eastern. Plenty of water to go under the bridge between now and then, though. Stay tuned here on Sky News Business.
New England and Lyne in New South Wales. New England, of course, around the Tamworth area. Lyne is on the mid-north coast, just south of or north of Taree, north of Newcastle, and it's that coastal area there, taking in towns like Kempsey and so on. These are two seats which have traditionally been Conservative leaning. They've been held by the Nationals previously. Lyne was held by the former Deputy Prime Minister Mark Vaile. In fact, in an interesting quirk to all of this, Rob Oakeshott used to be a staffer to Mark Vaile, the former National Party leader, the former Deputy Prime Minister, and the former National staffer might today make a decision that could either make a coalition government or indeed put Julia Gillard